Are you feeling a little lost in that alphabet soup of packaged products on the SIE exam? Yeah, trust me, you're not alone. So in this explainer, we're going to crack the code on three of the big ones: exchange-traded products, variable annuities, and municipal fund securities. And I promise, by the time we're done here, you are going to feel so much more confident tackling these questions. ETF, ETN, 529. I mean, come on, it is so easy to get these things mixed up. But don't you worry, we're about to make this stuff crystal clear. We're going to break down what these products are and, more importantly, what you actually need to know to nail these questions on exam day.
All right, let's dive right in with the first two on our list, ETFs and ETNs. Now, they both live under this big umbrella called exchange-traded products, or ETPs. They sound almost the same, right? But as you're about to see, the way they're built and the risks they come with are a world apart.
So, what is the deal with an ETF? Honestly, the easiest way to think about it is like this: it's a hybrid, a brilliant one, actually. On one hand, it's got the diversification of a mutual fund, meaning it holds a whole bunch of different securities all at once. But on the other hand, it trades on an exchange just like a regular stock, so you can buy and sell it anytime the market's open. It's really the best of both worlds. Now, here's where it gets interesting. Most ETFs are passively managed. That just means they're designed to track a big index like the S&P 500, and that's a huge reason their fees are usually pretty low. They're also really tax efficient. But here's a key point for the exam. An ETF's price can actually be different from its net asset value, or NAV. Just think of the NAV as the official sticker price of everything inside the fund. But since the ETF is trading all day based on what buyers and sellers are willing to pay, that real-time price can drift a little higher or a little lower than the sticker price. Okay, listen up, because if there's one comparison you absolutely need to lock in, this is it. An ETF actually owns the underlying stuff, the stocks, the bonds. It's a real portfolio. An ETN, on the other hand, it holds, well, nothing. It's basically just a promise, an IOU from a bank. And that creates a massive difference in risk. With an ETF, your main worry is market risk, the chance that the stocks inside go down. With an ETN, you have that plus the credit risk of the bank that issued it. If that bank fails, your ETN could be worth zero. That distinction is a huge, huge topic on the SIE. Okay, so we just saw how ETPs can blend different features. Now let's jump into another really interesting hybrid, the variable annuity. This is where the world of insurance literally collides with the world of investing, and what comes out is a pretty unique product that's really built for long-term goals. So how does this whole thing work? Well, you make your contributions, and that money goes into what's called a separate account. From there, you get to choose how you want to invest it in these different sub-accounts, which, for all intents and purposes, look and act just like mutual funds. But here's the cool part. Because it's technically an insurance product, all the growth inside that annuity is tax-deferred. That means your money can compound for years and years, and you don't pay a dime in taxes on the gains until you finally start taking it out.
But it's not all sunshine and tax deferral. This right here highlights the trade-offs you have to know. Yes, you get that tax-deferred growth, and you can get optional insurance features, like a death benefit. The flip side? They can have pretty high fees, and they almost always have surrender charges. That's just a penalty you have to pay if you try to cash out too early. And this is so important. These are investment products. They have market risk and are absolutely not FDIC insured like your savings account at the bank.
All right, so far we've talked about products for trading and products for retirement. This last category is all about investing with a very specific goal in mind. We're talking about municipal fund securities. These are special accounts usually sponsored by a state, and they're designed to help you save for big life events with some really powerful tax breaks. The undisputed superstar of this category has got to be the 529 plan. It's all about saving for education. So let's make it real. Say you're saving for your kids' college. You put money in after you've already paid taxes on it. But then, inside the plan, that money grows completely tax-deferred. And here's the best part. When you take it out for qualified education expenses, tuition, books, you name it, those withdrawals are 100% tax-free. It's an unbelievably powerful savings tool. Now, let's talk about another incredibly important type of account, the ABLE account. These were specifically created to help people with disabilities save money for their future. The key benefit, and it's a huge one, is that the money in an ABLE account generally doesn't count against them when they're trying to qualify for critical government benefits. For so many families, this is just an absolute game changer. And here we go, another point the SIE exam just loves to test. So listen closely. 529s and ABLE accounts are not bank accounts. I'll say it again. They are not bank deposits. Even though they're often sponsored by states and they're for saving, the money is invested in the market. That means the value can go up, which is great, but it can also go down.
There are no guarantees here.
Okay, let's just hit pause and zoom out for a second. We've talked about ETPs, variable annuities, municipal fund securities. We know how they're built. But for the exam, and, for the real world, just knowing the definitions is not going to cut it. This single most important concept that ties all of these complex products together is suitability. So how do you figure out if a product is suitable? Simple. You run it through this 4-point check. First, costs. What are the fees going to be? Second, risks. Are we talking about the simple market risk of an ETF or the market and credit risk of an ETN? Third, liquidity. How quickly can I get my money back if I need it? Is it easy like a stock, or are there penalties like in an annuity? And finally, tax implications. Is it tax-free like a 529 or just tax-deferred? If you can answer those 4 questions, you'll know exactly who that product is for.
And that really brings us to the final, most important idea. See, it's one thing to memorize what these products do, but the real skill, the thing that's going to get you a passing grade, is connecting the what to the who. It's not enough to know what an ABLE account is, you have to know who it's designed for. That's the mindset you need. So next time you see one of these complex products, just ask yourself one simple question. Who is this built for? The answer to that will tell you everything you need to know.